So this is the anatomy of a long call. So long calls can be a very good alternative to trade in the underlying because of the defined risk aspect of the asset or of the trade rather. So basically, it's very similar to just buying a stock and selling it later at a profit, at a higher price. To the upside, the profit is unlimited. So you're buying a call, and really, as long as the stock is above the strike price or the break even, you're going to be profitable, and the stock can go to whatever number as long as it's positive and it's above the strike, and you're going to be profitable. To the downside, the risk is limited and defined, which is one of the advantages of long options. That's one of the main reasons why people buy calls. They go long calls is because the maximum risk you're taking is the premium or the amount of money you paid up front for the option. So let's say the premium or the price you pay for the option contract is $2. So considering that every option represents 100 shares of stock, the maximum loss you can get or you can lose is $200. So 2 times 100, that's the maximum risk you can take. So if let's say the trade moves against the trader, and at expiration the market price is under the strike price or under the break even, the trader lets expire the option worthless and takes in the full loss, which is again the total premium paid up front for the option contract. So just to recap, long calls or buying a call, holding a call, unlimited profit, and limited and defined risk. What I mean by limited and defined risk is that obviously limited risk is that you can't lose more than the premium you paid, and defined is that you know what the max loss is. When you're buying a stock, the unless you're setting a stop loss order, really the only you don't really know your risk. The risk is unlimited and it's undefined, or it's limited in a way that the stock can drop to $0, but it is definitely undefined. You don't know what the risk is unless you're setting a stop loss order. This emulates a short position on the underlying asset. As seen previously, the directional position of a long put is bearish. Therefore, a trader holding a long put option does so in hopes of the price of the underlying to go down in price. So basically, when you're buying a put, you're holding a put, you anticipate the price of the stock to go down in value past your break even or your strike price. If the stock price of the underlying goes up in value, or if the stock price of the underlying moves against us, the maximum loss, the maximum risk is the total value of the premium paid up front, just like the long call. The risk is once again limited and defined. So if the stock price of the underlying moves down in value, which is in our favor what we want as a put buyer, the maximum profit is still limited because the stock can only drop to $0. It can't go under. Now this is short calls. Usually short positions in general, if they're uncovered, which we're going to see in a upcoming video, they're typically higher risk if uncovered. So call writing is equivalent to a short underlying position. To profit, a trader short a call anticipates the underlying to go down in value. The maximum profit earned on the short call is the premium received up front. So when we saw long puts and long calls, we were paying premium to the seller of the option so we could have the right to exercise the option if we wanted to. Now that we're selling the option, the buyer of the option, the person on the other side of the trade, is paying us premium to have that to have the choice to exercise the option or not. So, right, the maximum profit earned on the short call is the premium received up front. So the second you're issuing or writing a call or a put, you're receiving premium into your account. So if the trade moves in your favor, the call option you wrote will expire worthless, and you will keep the premium received when you first sold the call. Although receiving premium immediately after writing a call may seem very attractive, there is notable risk involved. Writing an option means that you have the obligation and not the choice. You have to provide the option buyer with 100 shares of XYZ stock at the strike price that was fixed initially when you wrote the option contract. You would, for instance, you would have to buy 100 shares of stock at XYZ, 100 shares of XYZ stock at market price, and then sell it to the option buyer at strike price, which would result in a loss. Now, remember, this is for a naked short call. There are other types of short positions that are called covered, which we're going to see in another video, as I said previously. This type of trade is very risky. Now for the other side of the put, the short put, when you're selling a put or writing a put, it's equivalent, directionally equivalent to long equity. To profit from writing a put, the underlying must move up in price and expire worthless. So just like the short call, basically you earn premium up front when you're writing the call, and you're hoping the option expires worthless and that the person who bought your call doesn't exercise it. If the underlying moves against the writer and the trader who bought the put you wrote decides to exercise or execute his rights, the writer will have the obligation and not the choice to buy 100 shares of XYZ stock at the strike price the option indicates from the buyer of the put, and if the trader were to sell it immediately, a loss would occur. So again, writing a put has a high level of risk if it's uncovered. So that's pretty much it. Very similar to the short call. Once again, you have high risk and you have the obligation to provide. You have an obligation if the person who bought the option you wrote decides to exercise it. So this is the last part of this video. Basically, important things you need to know before moving on. So first of all, covered versus naked options. I'm actually going to keep that for another video because it's kind of complicated. Well, it's not really complicated, but you really need to understand the concepts that I presented in this video before moving on to try and understand covered versus naked options. After that, basically commissions are part of your trade as well. Do not forget that and take them into account when you're calculating the break-even prices. So yeah, sometimes commissions can change what the outcome of certain trades. After this, you have calculating break-even prices is very important as they influence your profitability. All options contracts represent 100 shares of stock in the United States. All stock options listed on American exchanges expire on the third Friday of the expiration month. There are many options strategies that take in consideration statistics such as spreads, condors, J-lizards. There's a lot of strategies out there. Those techniques or strategies rather are more advanced, and they require really a good understanding of the concepts I presented in this video. Why trade options? I'm actually going to keep that for another video as well. And throughout the entire video, we were talking about a lot about exercising the option, because it sounds like it may be all about exercising the option, and the point of buying an option is to exercise it. But according to the CBOE, which is the Chicago Board Options Exchange, it's one of the biggest options exchange in the United States. About 10% of options are exercised, 60% are traded out, and 30% expire worthless. So basically what that tells is that people don't really buy options, or people don't really buy options or trade options to exercise them. A lot of the time they're buying them and selling them to either just trade the option contract itself, or they're just letting them expire worthless. So that's an interesting statistic I found. And that's pretty much it. Thank you for watching the video. I will be trying to release a video about ETFs, which are exchange traded funds, and also another options video about covered and naked options, as well as the advantages and kind of why someone would trade options.